Navitas Semiconductor, trading under the ticker NVTS, is currently priced at $22.65 as of May 12, 2026 at 11:45 a.m. Eastern Time, showing a slight intraday pullback after yesterday's massive 24.45% surge. To put this in perspective, the stock has been moving within a very tight and high-tension range today, hitting an intraday high of $23.82 and a low of $21.51 as the market tries to digest one of the most significant upward re-ratings the semiconductor sector has seen this year. While many casual observers are looking at the ticker and seeing a typical post-earnings pump, the reality under the surface is far more complex and involves a fundamental shift in how the industry views power efficiency in the age of artificial intelligence. Most investors expected a quiet quarter given the cyclical nature of chip manufacturing, but instead they were met with a 50% quarter-over-quarter surge in AI infrastructure revenue. This isn't just a small beat, it is a total change in the company's identity. The immediate reaction you see in the price today reflects a tug-of-war between institutional buyers who are finally seeing the Navitas 2.0 vision come to life and retail traders who are taking profits after a nearly 90% run over the last month. When you look at the daily trading volume, which has recently spiked to over 70 million shares compared to an average of around 35 million, it's clear that high-conviction money is moving in. This creates a fascinating tension. The general market narrative has long been that Navitas was just a small player in the mobile charger space, easily brushed aside by giants like Infineon or Texas Instruments. However, the reality is that they have successfully pivoted away from that low-margin consumer business. They are now focused on high-power markets like AI data centers and electric vehicle infrastructure, which now represent the majority of their revenue. This transition is usually a slow, painful process for most firms, but the speed at which it's happening here is what is catching the short sellers off guard. If you are using tools like the Robinhood mobile app or checking your individual brokerage account on Interactive Brokers, you've likely noticed the implied volatility on NVTS has been off the charts. This is the kind of stock that forces you to rethink the self-investing approach because the swings are so violent. For those managing their own intelligent portfolio, the question becomes whether this $5.3 billion market cap is a fair reflection of their $3.5 billion serviceable market opportunity by 2030, or if the stock has simply gotten ahead of itself. The expectation was that the company would remain a speculative bet on the fringes of the GAL and CIC market. The reality we are seeing in the latest data is a firm that is becoming a central pillar for 800-volt power delivery systems, which are essential for the next generation of AI compute power. When we look at institutional activity, the picture gets even more interesting. We are seeing major price target hikes from firms like Morgan Stanley and Baird, who are scrambling to adjust their models after the company showed an 18% sequential revenue growth. Usually when a company misses on earnings per share, as Navitas did, reporting a wider loss than expected, the stock gets hammered. But the market ignored the bottom line miss because the top line growth in the AI sector was so dominant. It's a classic example of looking at the signal versus the noise. The noise was the quarterly loss. The signal was the 35% year-over-year growth in high power markets. This is why having a solid trading platform like the Fidelity mobile app or using Interactive Brokers trading tools is vital. You need to be able to see these shifts in real time before the narrative becomes common knowledge on mainstream investing sites. Now, let's establish some common ground. Most people look at Navitas and see a hold because the average analyst price target is actually still significantly below the current trading price. The skeptical view is that the company isn't profitable yet and faces massive competition. This is the safe bet, but I want to challenge that with a contrarian take. The market isn't pricing Navitas as a chip manufacturer anymore. It's pricing it as an energy efficiency play for the AI power crisis. Every single Blackwell-class server that NVIDIA ships needs more power, more efficiently delivered in a smaller space. Silicon has hit its physical limits. Gallium nitride and silicon carbide are the only ways forward. If Navitas can capture even a fraction of the power delivery market for AI data centers, their current revenue of $8.6 million a quarter will look like a rounding error in 3 years. To understand where we are going, we have to look at what Navitas actually does. Founded in 2014, the company pioneered the first GAL power ICs. These chips allow power supplies to be smaller, lighter, and much more efficient than traditional silicon-based ones. While they started by making chargers for your phone faster and smaller, they've moved into the big leagues of power. Their recent partnership with Science Semiconductors to launch India's first GAL power IC family is a major development that many US investors are completely overlooking. It's a massive play for the growing tech manufacturing hub in South Asia. This is why some people on Reddit or specialized investing sites are calling this a mini NVIDIA for the power sector. Comment below how many shares of Navitas you currently hold, or if you think the shift to GAL is still a few years away from being mainstream. I'm curious to see if you're using Robinhood fractional shares to build a position, or if you're staying away entirely due to the volatility. The risk profile here is undeniably high. With a beta of over 3.6, NVTS is roughly 3 times more volatile than the S&P 500. This isn't the kind of investment for a conservative Schwab intelligent portfolio setup. It's a high-growth, high-risk play that thrives on momentum. If the broader AI trade cools off, Navitas will likely lead the way down. Furthermore, their heavy reliance on manufacturing and revenue from Asian markets, specifically Hong Kong and China, makes them vulnerable to any sudden shifts in trade policy or geopolitical tension. This is a reality that often clashes with the bullish expectation of a smooth upward trajectory. Looking ahead, the catalysts are clear. We need to see if they can hit their revenue forecast of roughly $41 million for the full year. We also need to see if their non-GAAP gross margins, which currently sit around 39%, can continue to climb as they move further away from the low-end consumer market. The expectation is that they will reach profitability when quarterly revenues hit the high $30 million range. If they hit that milestone earlier than late 2027, the stock could potentially double again. If they stumble on the execution, or if supply chain issues hamper their high-voltage CIC production, we could see a retreat back to the mid-teens very quickly. For those of you looking for investment help or exploring online investing options, it's worth noting how different this stock looks depending on the lens you use. If you're checking Fidelity mutual funds or large ETFs, you might not find a huge concentration of NVTS yet. But if you're looking at specialized tech ETFs or using a Robinhood investment strategy focused on moonshots, this is likely a name that has been on your radar for weeks. The key to Navitas isn't just the chips themselves. It's the management's ability to navigate the transition from a mobile-focused company to an industrial and AI powerhouse. The appointment of Tanya Stevens as CFO and David Lee to the board are signals that they are professionalizing for a much larger scale. In closing, the story of Navitas Semiconductor today is a perfect illustration of the gap between what the market expects and what the operational reality is. The expectation was a speculative, money-losing chipmaker struggling to find its footing. The reality is a company that has strategically positioned itself at the literal power source of the AI expansion. We've seen the live price of $22.65 hold steady despite the volatility, which suggests that the new investors coming in are more comfortable with the higher valuation than the ones who left at 18. The authority of the Navitas 2.0 narrative is currently winning the day. Whether you use Fidelity Wealth Management or prefer self-investing via the SoFi trading platform, this is a ticker that demands your attention, not for what it was, but for what it is becoming. The central insight here is that power is the ultimate bottleneck for AI, and the companies that solve that bottleneck will be the ones that survive the next decade of tech evolution. Expect volatility, but keep your eyes on the high-power revenue segment. That is where the real story is written. Whether you're browsing investing sites for the next big thing or just looking for a way to diversify your individual brokerage, understanding the difference between a cyclical chip company and a structural energy play is paramount. Navitas is making the case that it belongs in the latter category. It is no longer a question of if GAL and CIC will replace Silicon, but when and who will own the market share. The high-tension trading we are seeing right now is just the market trying to figure out if Navitas has already won that race or if the hard part is just beginning. As always, stay sharp, keep your stop losses in place if you're trading the momentum, and don't let the short-term noise distract you from the long-term shift in power technology. Authority in this market comes from recognizing these transitions before they are fully priced in, and right now, Navitas is giving us a front-row seat to one of the most aggressive pivots in the semiconductor world. Monitor those quarterly gross margins closely. They will tell you everything you need to know about the health of this transition, and whether the current price is a peak or just a base for the next leg up. This is the reality of the market. It's never just about the price. It's about the conviction behind it. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.